For a bit more on the outlook for the Japan economy, let's get back to our guest commentator, Peter Churchhouse, Advisory Director at Morgan Stanley in our Hong Kong studio. Peter, the optimism surrounding Japan has been palpable recently, not only because the stock market's been going up, but the evidence elsewhere has also been mounting. But an interesting story on the front page of the Financial Times this morning, in which they say that the Resona bailout that we saw is actually coming back to haunt the government, and the opposition are now claiming that it's fraud. That Resona was in fact bust at the time, and in bailing it out, the government was actually breaking the law. Interesting insofar as it was the Resona bailout which really sparked this turnaround in sentiment to a large extent, wasn't it? Are we going to suddenly see this momentum run out now? Is the sentiment going to reverse itself once again?
Well, the great thing about Japan, of course, over the last decade, it's been a theme of, if you might say, cyclical hope and structural despair. Every time we get some sign of a cyclical recovery that kicks the Japanese economy along a bit, but it never really catches on because we don't get the structural reforms that are needed. And I think the interesting thing about the Koizumi government is that they seem to at last have embraced the need for structural reform, and the Resona bailout was, I think, a clear indication of that. If it turns out to have been under false pretenses or illegal or whatever, I think that's by the by. I think the most important thing for the Japanese economy is that we have, I think, an administration now which seems committed to a path of structural reform for the financial sector in particular. So I'm quite positive and quite hopeful that Japan will engage in the structural reforms that I think the whole world believes and knows are needed. So yeah, I'm still quite positive on that, despite this latest information.
Thing is, though, it does change the scenario somewhat, doesn't it? I mean, okay, so they're committed to financial reform, but that was what we saw. That's what we assumed when they did the Resona thing. Okay, the question still remains, though: will they do any more? Because if we go back and say, okay, Resona was bankrupt, and they moved in there. They haven't moved ever since on any of the other banks. Are we not now going to go back and review the assumption that we've had with the other banks, which is that they're basically okay and will be moving their way out of problems with this stock market gains? Won't we be forced now to go back and reassess the strength of those banks and say maybe they too now need capital injections?
Well, I think, of course, it may well trigger a review process, if you like, but I think the administration is still very much committed to the principle of getting the banking sector sorted out one way or the other. The needs may be slightly different, or there may be a different raison d'etre or different amounts of money required, etc. But I think the basic principle of sorting out the banking system one way or the other still remains, and a review process may not necessarily change the course of that, but it may in fact change the way in which it is done and the speed with which it is done. But I don't think the basic principle is going to change.
How much of the recovery, if you can call it that, in the financial industry is real renovation of the way they do business, or are they just lucky because they were so slow to unwind cross-shareholdings and so slow to concentrate on, their core business of banking, that luckily they had stocks sitting around in their own portfolios which have zoomed up in value, and therefore people think, oh, they're doing really well now because they're still sitting on this pile of share certificates. I mean, how much of it is actual, fundamental change in the way business is being done? How much of it is sheer luck?
I think a great deal of it is perhaps sheer luck, but if you think about this business of the ownership of shares that the banks have had, if you go back a couple of years, we've sat on these programs, and every so often the experts would tell us, well, look, when the Nikkei falls to 12,000, the banks are bust. When it falls to 11,000, the banks are bust. When it falls to 10,000, the banks are bust. Well, they've kept on falling, and the banks are still around, and they're still there. So the importance of the share portfolios in all of this, in the capital structure of the banks, perhaps may well have been a little bit exaggerated. And of course, the fact that the markets moved moved up quite resoundingly in the last few months has meant that the capital situation of these banks is a little healthier. That is real, that is there, that is nothing, there's no smoke and mirrors about that, but the big question is whether they're really getting their core business sorted out and unwinding the bad loans and non-performing loans, etc. And the currency effect here may be a negative for this. If the currency keeps appreciating, you may find that perhaps foreign investors might find it a little less attractive to go in and buy up these non-performing assets.
There is a wide disparity of opinion, Peter, about how much of an impact the strength of the yen will have on the economy. Some people say anywhere above 105 is going to choke off the economic recovery. Many others say that's not the case at all. The Japanese exporters still make a lot of money at home, and they've hedged and well, I mean, where do you see a yen level where you'll begin to feel uncomfortable?
Well, quite honestly, I think we've seen the line in the sand was drawn a few months ago at 115 on the yen. I think the line on the sand has probably been redrawn at somewhere around 105 to 110. Our own view here is that the yen is going to strengthen towards 100. If we've seen this in the past, the Japanese manufacturing industry did perfectly well when the yen was around 100 and even stronger than that, towards 90 a few years back. Our own estimates here suggest that a yen at around 105, which would be an 8%, nearly 9% appreciation from the average earlier this year, would only have a very small impact on GDP of less than 0.4% to the negative. So our sense here is that the yen is perhaps it's too easy to exaggerate the importance of the yen as far as the exporters are concerned. And you mentioned hedging, you mentioned the fact that so many exporters today produce a lot in other countries, in the States, around Asia, and so on. And it's also worth bearing in mind that a stronger yen makes it cheaper for Japanese companies to import. A big cost of imports in Japan is oil. So a strong yen actually helps a lot of people as well. So I think the net, it's probably not as big an impact on both exports and the real economy as I think a lot of people would like to expect.
You know, there was a report out this morning saying that Sony is going to kick out 20,000 people off the job in the next few years because demand for CRT, old-fashioned big picture tube televisions, is falling. I mean, it amazed a lot of us to learn that they're actually doing that kind of low-tech manufacturing, which the Chinese can do cheaper and better than the Japanese. Is there another shock to the manufacturing sector coming in Japan?
Well, I think you've seen already huge amounts of exporting companies relocating plant to other parts of the world. And for example, as you mentioned, the Chinese have actually provided the huge boost, if you like, to the Japanese exporters. And if you look at last year's or the past 12 months numbers, something like 83% of the total growth of Japanese exports has been accounted for by China. That's the additional growth that we've seen. So China is acting as a huge magnet of growth for many of these companies, and I think I'm surprised that people like Sony are still making that kind of stuff in Japan. I would have thought if there's a need for it, they could have certainly have done it elsewhere, as the Taiwanese are finding, and as we're seeing also with the Koreans, huge amounts of cash finding its way into China, where they can produce this stuff at a third or a half the price of their domestic markets.
All right, Peter, we'll wrap up there, come back and talk a little bit more later on in the program. Peter Churchhouse is with Morgan Stanley in Hong Kong. He'll join us again after the top of the hour.